What it do, y'all? Chase Taylor here with a new episode of Tailor Made Macro, where we let others stay on top of markets while we try and get to the bottom of them. My guest today is my friend Harris Kupperman, aka Kuppy, and we go deep on what inflection investing is, the difference between technical momentum and fundamental momentum, the importance of taking time away from markets, not just multi-week vacations, but getting away often during the trading day itself to clear your mind. One point I did not make during the show that I wanted to talk about for a second was about fundamental breakouts. You ever notice a stock that makes a big move on earnings day thanks to something that was not new if you were following the company closely? This is why Kuppy's fundamental breakouts lead to technical breakouts, and it's why Kuppy has a consistent track record of great returns. I think you guys are really going to enjoy this one. As always, go to pineconemacro.com and click on the TaylorMade Macro tab for detailed show notes that include transcript, links for the books mentioned, and of course Kuppy's blog, research service, website, Twitter page, and much more. Just remember that nothing my guests and I discuss is investment advice or a recommendation of any sort. We're just exchanging ideas. Before we start, if you invest your own money and enjoy thoughtful, independent research, please check out Pinecone Macro Research at pineconemacro.com. We're happy to provide samples if interested. If you enjoy markets but prefer to have the pros invest your money, please check out Bulwark Capital, where I'm the head of research. Go to bulwarkcapitalmanagement.com, and that is bulwarkcapitalmgmt.com to learn more about the firm. All right, on to the show. My guest today is my friend Harris Kupperman, better known as Kuppy. Kuppy follows Brent and Kevin because, like them, Kuppy has done a ton for me in my business. Kuppy's recommendations have always led to surges of new clients for me, and without that, I would probably still be toiling away for the Air Force in DC instead of doing what I truly love every day. I wanted to show my gratitude for that by making Kuppy one of my first guests so that I could thank him publicly. That's why I care about Kuppy, but you should care about him because Kuppy is a value investor that makes money. I repeat, a value investor that makes money. While the average value investor has been run over, Kuppy is often on top of big, under-the-radar winners. I'm not going to have Kuppy tell you for the millionth time why Joe and Sput are good investments. Instead, I'll do what I love to do and dig into his process and try to have him coach me into taking more time off and improving my inflection radar. Kuppy, you're a friend, a mentor, and I have tremendous respect for you as an investor. Thank you for all you've done for me over the years. I think we're going to have some fun today. Welcome to the show, brother.
Hey, thanks for having me on the show, and thanks for the kind words. I didn't realize I brought you that much business. I just genuinely enjoy your weekly.
Well, that's why we're doing this, so that I could tell you. It's really helped me. So as the listeners of all two of the podcasts will know, we have the charity buzzer for anytime someone says good question. So for every slip today, so first of all, Kuppy let me know, like, hey, you go ahead and pick the charity. So every time Kuppy slips up today, we'll be donating to the Democratic Congressional Campaign Committee. Just kidding. We'll be donating to the Sugar Pine Foundation. When we lived in Northern California, we spent a lot of time in Tahoe. Loved that area. And of course, I liked the sugar pines because they have dog-sized pine cones. But white pine blister rust is a fungus that destroys those trees. It kills 95% of the trees it infects, and sugar pines at one point were 25% of the forest around Tahoe. Now they're less than 5%. But the good news is about 3% of the trees are resistant to blister rust. And the good folks of the foundation, they round up the pine cones to create seedlings, and they go plant them. So thank you for helping me save some pines today, Kuppy.
Yeah, I'm excited for it. That sounds like a good one.
All right. So you got a lot of Zimbabwe stuff going on here lately, but I want to start with Rome because you studied Roman history in college. Your firm's named Praetorian Capital after the Praetorian Guard. So I want to know why you chose that major and that name for your firm.
Well, why I chose that major, my junior year of college, I told my dad I was leaving college. I had turned the $6,000 I made cleaning pools one summer into enough money that I was making more money than him. And he went to college for about 15 years to become a doctor. And I told him he was just wasting his time. He should have traded. And I told him I was leaving college because it was getting in the way of my trading. And he told me that I wasn't allowed to leave college and he's going to kill me if I left college. But I didn't have to actually study a real subject, so I decided to be a Roman history major. I'd always been interested in it. Do what you're passionate about, right? And so that's what I decided to do. Why Praetorian Capital? I don't think we've actually talked about this, but if you think back to Roman times, the Praetorian Guard, they were there to protect the emperor and enforce the emperor's will. And, occasionally they'd get sick of an emperor and chop him to bits. And I kind of saw our role, especially given that the firm started doing a lot of small cap, in a similar way. I feel like a lot of small cap companies might be really good at building widgets, but they're terrible at Wall Street. And they get chewed up by investment bankers, and they get chewed up by everyone on the street, and they just can't even tell their stories. They get a crappy valuation. I felt like there's a lot of opportunity for us to fix that issue and make appropriate recommendations and referrals, and fix their marketing and their go-to-market story to Wall Street for the valuation side. But at the same time, we didn't want to be seen as a bunch of patsies, and we're fierce and we got knives, and don't screw me. So that's kind of the approach we took.
So that's awesome. I always kind of wanted to know on the name. I'm glad I asked. So a few people beat the markets. A lot of people prefer value in the markets. I think the Venn diagram that overlaps those two is microscopic, but you consistently lean towards value and you consistently make money. So my assumption is you kind of credit the way you lean on inflections for why that is. I've heard you talk about that a lot, but I really want to know exactly what you mean by inflection investing. And this is something like I really want to go deep on because I think it's what sets you apart. And hopefully it'll fill in the gaps for some of the mortals out there that would love to beat the market, but don't really want to buy Mag 7.
Well, when you think of value, you end up thinking of stuff like IBM and Xerox. Go pull up one of the value ETFs, quote unquote value. And it's just a bunch of like boring, dying businesses. And then everyone else who's a value investor, they think they're all special because they found the small cap version of Xerox. And they're not special. They're just in a boring, dying business. And yes, it's cheap. That's not how you make money. There's stocks that were cheap 20 years ago when I started in this business, and they'll be cheap when I retire. They'll just never work. And that's just the nature of value investing. It's a lot of just crap. I think what I've done with Inflection is done a value overlay, but it's momentum investing, really. I'm finding stuff that has massive, massive tailwinds. It's just that my entry price isn't, 100 times sales. My entry price is 10% of replacement cost, or it's 3 times cash flow next year, looking forward. But I'm buying stuff where, revenue is growing rapidly. I'm buying stuff where value creation is happening rapidly. I'm buying, growth momentum names, but I'm buying them before anyone else realizes they're growth momentum names. They're still valued like value stocks. If you look at this sort of stuff we're doing, I call it inflection investing, for lack of a better word, but they tend to be industries that have destroyed a lot of capital, that have bored people to death, that give people PTSD. They're things that, there's no analyst coverage anymore. No one wants to hear about it. No one wants to think about it. They tend to be cyclical businesses that are undergoing a secular change. And that's what we get involved in at a moment where it's hard really to lose much money because expectations are so low. And if anything even sort of goes right, you're going to get a reval. But, usually I'm looking for stuff with such massive tailwinds that when it goes right, I'm not looking for a 50% reval. I'm really looking for a 5 to 10x. And I think that's the other thing that, sets me apart from other guys. There's so many guys that come into a story and they say, look, I did the DCF, it's worth 30% more. And to me, that's just random market, movement. That's just random noise. I mean, I'm looking for stuff. I won't even touch it unless it's a 3x in 3 years, but I'm really looking for 5 to 10x, which means that I'm very disciplined. We say no all the time. I don't even want to have too many friends telling me what they're looking at because I'm just going to say no and waste their time, waste my time. We're looking at stuff that you can make a 5 or 10x on. That's what keeps me disciplined. And, if you think you're going to make a 10x on something, you could have a lot that don't work and you lose 10%. You could have a lot that kind of go nowhere. Those 10x's in your book, that's what makes your numbers.
So you said something there that I want to go into. Cyclical sectors undergoing secular change. I think that's a really good way to describe, what you do. And I kind of flight follow what you do, not just through your writings, but I pull your 13F every quarter and take a look at what you're up to. So, because I like to see this stuff, and a lot of it is, it's like a lot of middleman type businesses, like stuff that's stuffed in the middle of a supply chain. It's so no one cares about it because it's not at the very base of it, and no one seems to care about it because it's not at the top of it. But anyways, we'll get to that later. But cyclical sector, secular change. What are some examples of secular change that you've picked up on, or even watch out for in some of these cyclical sectors?
I mean, I don't want to go too deep into it, but like, I've been talking about uranium. Look, everyone hated uranium 5 years ago. Everyone said uranium was going to be going the way of the dodo. They're going to shut all the plants. And now, look, if I'd come to you with that, 60 years of baggage and said, we found this new technology, it's the cheapest electricity, baseload power, super reliable, everyone would be so excited about it. We wouldn't be building solar panels and windmills. We'd be building nuclear power plants, and I think the world just had a reawakening, and that's secular. I think market share of nuclear power is going to grow, basically the rest of my lifetime. That's a secular change in a cyclical industry. Those sort of things are what I'm looking for.
Yeah, perfect example. You did say...
I should point out, a lot of guys, they trade in and out of these things. They buy, they sell, they buy and they sell. Look, we got into uranium when it was at 31. It's right now 90. That's been a good return. Not great, not my best, not my worst. But it's mid-cycle of the ownership. I know a lot of friends that have made a fraction of what I've made. They were earlier and they sold the pops. They meant to buy the dips. They didn't buy the dip, or they bought the dip, but they paid a bunch of taxes and the slippage, and they missed a piece of it. It's just amazing how many guys, they'll call me up. Hey, Kuppy, did you hear this? I heard this is happening, and then that's happening, and I don't care. If I have to suffer through a 50% drawdown in the price of uranium, that's just the price you pay on the way to wherever it's ultimately going to go. And I'm just amazed. I was in Bitcoin. I did very well in Bitcoin. I didn't even believe in it. It's just a Ponzi scheme. I have friends who just believed in it in their hearts of hearts. All they wanted to talk about was Bitcoin. They watched 8 hours of YouTube videos all day. And I made a lot more money than them, percentage-wise, because they missed parts of the trade. Something would happen and they'd get scared out of it and think they could buy it back cheaper, and they didn't. Or, they said, oh, this chart's extended. I need to buy the pullback. Or, it's making a this triangle instead of that triangle. Let me sell it. Like, I think there's too many people that show up to work every day and feel like they have to stay useful. And, I think this is one of the things we wanted to talk about, but I go out of my way to find ways not to be in the office, because all I'm going to do is make a mistake.
Yeah, it's funny. I fight this balance. And so going back to my time in the Air Force, I think it helped me to have to go to a job where I couldn't stare at the screen all day, in a sense. But then there are days where something really changes, and if you move on it quickly, it can be a big deal. But that might all get unwound by all the times you do something stupid because of one of those triangles that you're talking about.
Yeah, I mean, I try not to look at charts very much. Given our size, and our fund's grown up a bit, we're going to make the chart on the way in and the way out. So I don't care about the chart. If I make a decision to do something, it's going to make the chart, and it's going to take us, a couple days, maybe a couple weeks to, unwind what we're doing.
Yeah. So speaking of that, like, you're going to make the chart. Like, whenever you said that you almost have like a momentum overlay, and you kind of made it sound like revenue momentum instead of. So I'm assuming you don't mean price momentum, but you mean more of a momentum in the fundamentals.
Yeah, that's what I care about. I underwrote something happening. Is it getting better incrementally or worse incrementally? It's all I care about. I have an endpoint, and is each incremental data point better or worse? Or online. Online means I'm going to make 5 to 10 times. If it's worse, well, maybe I'll lose money. If it's better, maybe I'm going to do better than the 10 times. But that's what I'm tracking with each piece of data. And I'm that focused on, oh, this is going to happen, so then that's going to happen. I bet it dips 10%. Let me sell some and buy it back. Like, that's just not how you make money. That's how you miss the trade.
Talking about those 10Xs, those 3Xs, whatever. I've noticed on your winners, you never really catch the entire move, but I find that to be a feature, not a bug. I think at the end of moves, it's like everything is incredibly dangerous at the end of a move. The risk reward is so vastly different from whenever you got into the trade. Do you have any sort of like exit criteria? Is it more when something else is calling for your money, or is it those endpoints on the fundamentals? How do you think about exits?
It's really when something better comes along. I have a limited amount of capital. I'm going to work my money as hard as I can. And, if something better comes along, and we'll recycle the capital. I like to say that if you bought my winners and held 6 months, you'd have the best performing hedge fund. And it's true, though, because at the end of the move, you get this like exponential blow off sort of thing. I still don't know why that is, but I feel like we're a nation of Momo chasers. And you have quantitative programs that buy it, and you have ETFs that have to keep reweighting it as it goes up in market caps. They have to buy more. We have all these overlays that are reflexive that push it higher, well beyond anything that I think is logical in terms of valuation. And so I'll sell it, and then it just moves. But it's fine. I've never lost sleep over it. when I'm out, I take it off my screen. I never think about it. You know, my dad, he leaves everything on his cell phone. And 2 years later, he goes, "Hey, Kuppy, what's happening with this?" And my dad, you know, I call him Kuppy. He calls me Kuppy. And it's just amazing. He'll ask me and I'm like, "I don't know. I'm not following anymore." He's like, "Oh, but this has happened." I'm like, You know, it's just, once it's done, you have to stay disciplined. You can't watch something because you'll end up getting dragged back into it. You have to just say, "I'm done. I made my money. Time to move on."
That's might end up being like the title of this piece. That is phenomenal advice. I sometimes I do that and it really helps, and sometimes I don't, and it's like torturous when you don't. So that's honestly a underrated thing to do. One thing I want to talk about a little bit is sizing. I think we all know at the end of the day what differentiates investors is getting a couple of calls right here and there, and then having size when you do it. How big are you willing to go? And more importantly, how do you manage big positions differently than smaller ones?
Well, I don't really do small positions. There's just not that many good ideas out there. I mean, I wish there were. Look, I'm capped. It's a self-imposed cap at 35% at cost in any one sector, 20% in any one ticker at cost. Obviously, if it goes against me, I can average in a bit because, you know, it goes down in cost. And then I tend to let these things just run. I have no problem with a sector being 50 or 60% of my fund. Like I said a little bit ago, it's your 10 baggers that make up for all the mistakes. You can't be cutting them back too soon because you don't end up with 10 baggers. You know, one 10 bagger over a couple of years will hide all the errors you've made, and no one will know about it. And you know, I think this is one of the problems with the hedge fund industry, really. I think a lot of guys show up in our industry and they say, let's do something that has, you know, super low volatility. We're going to do 12% a year with less than 50 bips monthly volatility. And as a result, they set themselves up to underperform. There's very few guys who show up like me and say, I'm going to have a huge year. And if I'm only up 20%, that's because I screwed up. You know, like it's just a different mental approach. And if you have that mental approach where you say, man, I'm really shooting for 100% this year or more, then, you know, some years you'll hit it. Not every year. And this isn't, you know, guidance. Please don't hold me to that. That's not a recommendation or, you know, a sales pitch. But if you go out there looking for triple digits, you're going to hit it sometimes. And the only way you're going to have triple digits, you know, in a market that's definitely not doing triple digits, is to have a very select handful of ideas that you size super big, that are super torquey, and you let them just run. That's the only way it's going to work. And, you know, if you look at anyone who's ever done really well and had big years, you know, look at the Market Wizards guys. You know, they bet the whole thing on corn or wheat or soybeans, and, you know, it just kept going and it trended, and they were 5x levered, and they kept pyramiding in, and they ended up with some huge year. And that's just how you have big years. Have super concentrated, high conviction bets.
That's always been like jived with me, and I've never understood why people do it. Like the current, you know, hedge fund way. The ones that are trying to go out and get, you know, pension money and stuff like that. I just have never understood that.
Everyone is. I know exactly why they do it, because look, I know that at any moment in time we could have a down 35 drawdown. It would be totally in my expectations. I tell that to everyone who ever invests in my fund. Like, we expect to be down 35. It's not like, you know, this is, you know, the worst case scenario. This is like the mid case. The worst case is worse. Like, this is what we expect. And that's the nature of buying a stock at 10. It goes to 30, and then it pulls back to 20, and we still have a double, but that's a 1/3 pullback. And you do have a little bit of leverage. That's going to be your 35. And that's just how it's going to work. And you can't go to a pension fund and raise money. Those guys will never give you money if you have even 10% pullback. And so guys they get in their head that they're going to raise $1 billion because you get $20 million a year in management fees out of that. And they've designed their portfolio and their strategy and everything they do around them to not even have a 10% pullback. But if you're not going to have 10% pullbacks, you're not going to have any upside either. And I think, you know, when you look at the hedge fund industry right now, it sort of worked in a range-bound market like we had last decade. You know, range-bound, slightly, you know, tilted upward market. It doesn't work in Project Zimbabwe when the market just goes up a lot every year. Hedge funds have underperformed for 4 years in a row. I mean, they've underperformed everything. My mom owns Apple. She's outperformed every hedge fund in the galaxy, and she doesn't even know the login for her brokerage account. Like, it's embarrassing to my mom. Love your mom.
So something we talked about before the show and that you kind of alluded to that I want to talk to you about, and that is getting away from markets. It's something I'm truly terrible at. I'm addicted to markets. They're kind of like oxygen to me, but my level of, you know, FOMO is extreme from stepping away. Like I intellectually understand the benefits of unplugging from the market, but I also don't feel that equipped to do it. So talk to all of us about, why you find that important, how you tend to go about it. And then I'm going to look for some personal advice on how I can work on it.
Well, you have to publish weekly. You're screwed.
That's partially true.
I mean, for me, I just know that if I don't get away from the markets every couple of months, every 4 or 5 months, you get too granular. You get too drawn into, hey, what's this data point? What's this Fed speaker saying? Oh, this Fed speaker said something, 10% directionally different from that Fed speaker. In the end, it doesn't really care. I'm going to own something like uranium. I've owned it for 2.5 years. I'm probably going to own it, another 6 to 36 months. It just doesn't matter. So what's the point of drilling down on the whole thing? All you're going to do is just burn yourself out. And, I know when I come back to the markets, I'm so fresh. I could do, 5 all-nighters in a row if I find something interesting I want to learn about. But I also know that I come back and with a very big picture view. It's not like I ever completely leave the markets. I'll check at what's happening 8 a.m, Eastern time. So whenever I'm in Europe, it's like dinner time. I'll check my quotes 3 or 4 times, during the trading session before I go to bed. But nothing's really going to happen. You try to time it away from earnings season. So it's not like you're like missing an earnings call. But quite honestly, in a typical quarter, there's about 10 weeks where nothing happens. There's 3 with earnings calls. You just time it around that and you need to get away. And I find that the first week I'm away, people keep finding me. I have a team here. They reach out to me. I promised to do a podcast with someone and I got to still do the podcast. I have a client call. I still have to do the client call. By week 2 or 3, I haven't booked anything and I'm just free. And the further you get away from the markets, the more you can relax and just get away from it all. And it's just a great, great thing. And like I said, in an ideal world, I try to take the whole summer off, get 5 weeks out of it. And around Christmas time, market's slow. I try to get 3 or 4 weeks out of it. And I really do unplug. I stopped answering emails except the urgent ones. And look, I have a team of people. If something really important is happening, they're going to, my phone will just light up and I'll know to open my laptop and get to work. But it's designed so I can get away. I think the other thing I want to say is I try to get away during the day too. I'll see the open around noon or 1. I have a farm. It's not a very productive farm. All I seem to grow is mosquitoes. But I have a lot of fun there, just, taking my machete out and hacking at the vines. And, I'm away from the markets. I listen to a podcast, I'm away. And it was super hard for me to do that a couple of years ago. I was always worried, what if the 9/11 happens and I'm not there, and I'm going to be down 15% by the time I drive back to the office. I can't be down 15%. My clients be mad, I'm going to miss something. And I came to realize that with all the HFTs out there and all the quant guys, if something like 9/11 happened today, everything would reprice 15, 20% before I was even notified that it happened. Like they would see it, the super fast algos would read the news coming in, they'd move everything. So what am I going to miss? What am I going to trade against? I'll get 500 shares off. We're going to have millions of shares. We run a reasonably large fund. Like it's what are we going to do about it? You're not going to be able to go there against the machines and try to get it done before them. You're just going to be reacting to what happened. Well, so I'm not going to miss anything. Who really cares? Like if something happens, who cares? Once you're freed and liberated from that, you don't have to worry about it. Then you can actually turn your mind off and not have to worry about the markets. You don't have to worry about some broker calling you up. Kuppy, I got 50,000 of this to sell. Kuppy, I got a blocker list. Do you care? It's just this giant distraction that happens during the day that it just makes you unable to actually think through a project because there's always someone coming into my office. My phone's always ringing about something. It's just so much better to be out there in nature. Like I said, listen to a podcast and hacking at blinds. You can actually fix a problem through.
Yeah, I always find my best real idea generation, I always say the average work day, I'm just collecting a bunch of dots. And I find that I can't really connect those dots unless I'm out in the woods or on the water or, really away, which makes me feel like if I took a multi-week, no kidding getaway, vacation, the dot connection possibilities are bigger than I realize. So I hope to lean into this and be able to do it. And a lot of what you just said, answered some of the follow-up questions I had already. You do kind of check here and there. And exactly the fear you outlined is some massive thing happening. And you're right.
What are you going to do
all
about
that
it?
will be arbed out instantly. And the one thing that...
What's going to happen? It will be limit down by the time you even put a trade through.
Yeah, and then the other stuff where like the market doesn't realize it, like going back to COVID, whatever, like it gives you weeks to figure it out anyway, right? Like
Yes,
that
yeah.
was like a multi-week thing.
Yeah, I mean, I remember when they had the Japanese earthquake. Was this 15 years ago now? And I remember it was 3 in the morning, and my roommate at the time, who's now my COO at my hedge fund, I woke him up and I said, "Something's happening in Japan. You got to wake up." And we were just like sitting there in our boxers, literally trading, Nikkei futures. But like that was a different world. Now this thing would price instantly. It wouldn't even be worth waking up. It's just a different world now. So what's the point? I think what you'll find is as you get away, you'll be able to solve the big picture questions that, you never even thought you didn't have a chance to solve. Everyone's so focused on the short term, what's this company going to earn next quarter? And they never take a step back and say, should I even own this business? Is this a good business? Is this a way to express my view? Or is there, or is this suboptimal versus some other, CUSIP to express some sort of macro view I have? Instead, they're so focused on what this quarter means, and that press release came out, and what does that mean? Like, you just need to step away from the whole thing.
Yeah, 100%. That's exactly what I want this show to be about, is kind of like reflections instead of reflexes. And largely because I just want to train myself out of being on the latter end. So I've heard from my good friend Jason Polanski all about the good things that come from surfing. Speaking of kind of trying to get away, clear your mind type thing. Um, I know that you've taken up surfing down near the Puerto Rico Trench. Talk to us about that, why you like it, and what you get from it.
So I'm a terrible surfer. I don't think you could teach a 43-year-old new tricks. Fortunately, I'm good at stocks because I'm really bad at athletics. But no, look, I really enjoy it. It's great to have this theory about being on the water with sun and getting your heart rate up at some crazy level. It's just a cleansing thing. It's something amazing about actually catching a wave as opposed to just getting plowed by a wave. It's just like this liberating, great feeling. I think that the number one thing I like about it is that for 2 hours, I am away. When I'm on my farm, you can still ring me on my phone. You can still find me. If I go to the gym, everyone could find me. I'm still on, some blog reading it between sets. But when I'm out surfing, like you can't find me. I'm usually out with a couple friends of mine, so we're talking markets, but we're not getting interrupted by every stupid data point. Like right now, there's just so much stimulus between, text and WhatsApp and Bloomberg and Discord and email. Like there's always something popping off and you can't even complete a thought. And there, I'll be out there with a couple other guys who trade markets and we can complete a whole thought. It's just better.
Yeah, that's nice. I'm one of those people that I'll have like 1,000 tabs up and I'll get, a third of the way through some article and then it'll bring something up and I'll go look at the chart and then like somebody texts me like, yeah, so like I really understand the completing a thought part there. So I know you travel a lot. So we're talking about these like, multi-week vacations you take. And for people that don't know, it's kind of like all over the world. And you've lived outside of the US. So my question is, if you had to move outside of the States and it couldn't be somewhere down in the Caribbean, where would you move to if you just had to pick up stakes and go somewhere and stay there?
I don't know.
Of all the places have you gone?
It'd have to have good food and good weather. I mean, it'd probably be somewhere in Spain or Italy, right? Good food, good weather. I don't know, Greece. I mean, it's somewhere around the Mediterranean.
I notice a pattern with weather. We're gonna talk about that later.
I don't like cold weather.
So let's talk about how you handle losers real fast, and then we're gonna do some real fun to do between two pines, and then I got some more questions for you. So
I'm terrified of that part.
Losers,
You got
I only came up with three. I think I've come up with four for everyone else, so it'll at least be short. So you seem good at ejecting losers before they do too much damage. I think any of us that have followed you for a long time will never forget you just throwing in the towel and shorting Tesla years ago, and a bunch of knuckleheads got completely run over in the time since then. How do you think about exits? How do you think about when you're wrong? Is it like a hard stop, a time stop, a fundamentals diverging stop? How do you think about the ones you get wrong and getting rid of them?
So when I'm wrong, I just get rid of it as fast as I can. I find way too many people say, oh, this thing is cheap, or, maybe next quarter will be better. Like, look, when the thesis changes, my capital is really, valuable to me. I just want to be out. And I don't even try to work the order, I usually hand it off to a broker and just be like, get me out end of day, just massacre the thing, get me out. Because I just know that if you try to massage it and you try to get a slightly better exit price, you might change your mind. You might, be like, oh man, I was trying to sell it at 10, now it's at 9. I'm gonna wait for a bounce at 9.5. It's just like, nah, just get me out at 8. I don't care, just get me out. Massacre the thing if you have to. I just want to be out. I think the harder ones are when you have an inflection where it's inflecting, but it's not really inflecting with the sort of intensity you expected. And, we talked about, you have your trend line, and sometimes the things go better and, you have more torque and more upside. Sometimes it goes worse. And, you underwrote a 5X and you're kind of like, maybe it's a 1.5X, maybe a 2X. It's still working and it could get better. And you just kind of like, every quarter it comes in, you're like, man, these guys kind of sucked. And, I thought this would happen and it did. And at some point you just have to toss it because you need the capital back. But it's sort of working. I find those are the worst because you end up making, 50% on something over 3 years when you had all these other ideas that were doing 5X. And it's just like, it's dilutive to your returns. And, especially because I know that, there'll be some slippage on the way out and it's messy. I think that's the hardest part of some of these, where it's sort of working, but it's not working. When it's not working, it's super easy. You just blast the thing out. It's when it's sort of working. I think the hardest, honestly, is when it's really, really working and, you sell too soon. That's the harder one. I don't know. I hope I answered that.
No, you did. And I have a follow-up that I'll get to after Between Two Pines, but let's have a little fun before we get there. So, first question, and my personal favorite. Who is the best president in American history, and why is it Joe Biden?
Oh, God.
So these are all rhetorical, but I actually want to know who you think the best president in American history is. I'm curious.
We never really thought about this. It's probably one of those guys like Coolidge because he just did nothing. He just didn't show up and he let the thing run on autopilot. I think that's kind of how...
I thought you might go there. You'd probably be down with the one of those...
Coolidge or Harding, one of those guys just kind of left it on autopilot.
There you go. You seem to really like Florida. What is it about bottom shelf liquor, free range anacondas, hot nasty air, and roaches with wings that you like most?
Florida's not that bad. Look, Florida is the most bland state of all of them. There's like no endemic culture. It's just a mismatch of everyone else's culture all pushed together. I feel like Florida is just like solving for an equation in everyone's life. No one ever has like their first choice of where they want to be. It's just like a default option. It's like you hit 75 in New York and you just have to go to Florida. It's like by default. But I lived in Miami 17 years. I genuinely enjoyed it. It's like a modern, generic American city. All to look the same. It's really not flying Florida well.
Yeah, normally I feel like you're like a travel agent for Florida. That was you undersold it for yourself there.
I like the Panhandle a lot. The Panhandle is genuinely its own culture. It's basically southern Alabama, except where, say Joe has their land, the 30A, it's like the 0.1% of the South. It's where, the Hamptons basically for the Gulf Coast, because the Gulf Coast, if you go in Louisiana or around Houston, it's gray water. So it's the first place with really nice water. It's beautiful there. And, really rich people usually make things nicer. And so you have good restaurants and, it's just a good, like, southern hospitality. It's weird because, I come there from Miami where everyone's kind of an asshole because Latin America. And then you go to 30A and there's guys, on their bicycle and it's like, good day, sir. And you look at them and you're just like, what the hell's going on here? It throws you for a loop for a bit because you forget how friendly everyone is in the South and they can't just pass you by without saying hi. It's just different. I like it.
It's true. I grew up on the Gulf Coast in Texas, and like everyone waves to each other, everyone says hi. And I, having lived out a bunch of other places, I do miss the southern hospitality for sure. You seem to have a thing for conspiracy theories and for shooting iguanas. Is it fair to assume that you're preparing for the final battle against the lizard people in DC?
I wish. I'm not a very good shot. Fortunately, my friends are better shots. I just give them my rifle and I kind of carry the pellets. No, we got to get rid of the iguanas. They're invasive. They're eating all the bird life, which is, is sad. And they're also eating all my fruits and vegetables, which is even worse. I don't know. In terms of my conspiracy theories, a good chunk of them have been coming true lately.
There are some conspiracy facts mixed in. I'll allow it. All right, that's enough between two pines. I'm gonna have it back on someday in the future. We'll get to more of those. I'll come up with more.
Good, let's do it.
So you said something a minute ago that triggered something in my head, and that is like these guys suck and these guys this and that. Like that makes me realize you like do a good bit of work on management teams. That becomes clear to me through listening to you. How often do you talk to the management teams from the companies in your portfolio? And what does that look like? Like what does all of your management team research look like? Not to mention, communication, if there is any.
So, I mean, the first thing is if you're going to have a really concentrated portfolio, you're not allowed to have mistakes, right? I don't believe in, anything less than a 5% position. If we're going to play it at 2%, let's just not play it. We're never going to do the research. We're never going to have the confidence in it. I really want to do 10% minimum positions, preferably bigger, which means you can't get it wrong. And one of the ways you get it wrong is when management does something absolutely retarded. You wake up in the morning and they announced, a down round capital raise when they don't really need the money because some banker, twisted their arm and told them how great they are, or, they did some stupid M&A thing that destroyed a ton of money. So it's important to understand management. Problem with management, and I think most people fall for this, is that to become CEO of a company, unless you're the founder, to become the CEO means you're a politician and you're likable. And the board likes you, and you've played politics against the other vice presidents to get to the top, which means that in a 30-minute interaction on a Zoom call, you're just likable and kind of how to talk to me. And, it's like a first date and you're really good at it. And I'm kind of drunk. And it's just like, it's not good to have interactions like that. I try not to have too many interactions with management because you end up liking them. And then you see the benefit of the doubt and all their screw ups. And it's almost better just to look, any of these guys, they leave a long paper trail. First thing before we invest in anything, we obviously just Google the guy. Like, you'd be amazed at all the crazy stuff you'll find in the local papers on the guy. But they've worked at other companies. You can see their past history. Oftentimes, having done this now for 25 years, we know management at the other companies they worked at. So you do background checks on these guys. And you just follow them through. If it's a founder-led company, it's very different. I genuinely prefer those because you have a long paper trail where you know exactly what the guy's done. I try not to interact too much with management. We'll go to conferences and stuff, and I'm usually the guy who sits there kind of quiet and just listens to all the other questions. And I think when you're the one asking the questions, you get so caught up in the answer, and you think the guy's so great because he has the best answer to your question. And when you kind of take it a step removed, it's better. And I'll admit, most of the questions at these conferences, it's some pod shop, and they go, blink twice if you're going to beat by a penny, blink 3 times. But that's the question, right? And the thing I want to know is, what's your 5-year vision on how you want to redo your marketing approach? That's the thing I want to ask. And they're asking, what's next quarter look like? But you get a good feel for the guy, but I really try not to get too close to them. If you look at the stuff we invest in, they tend to be asset heavy businesses. They tend to be cash flow heavy businesses. Look, I think the guy running Valaris is outstanding. I've only had one call with him. I had a couple questions. I met him in person. Sorry, not a call. I had a couple questions, but in the end, coming out of this recovery, we saw how he played his hand. He had the worst hand coming out of bankruptcy. All his vessels were cold stacked. You see how everyone else played their hand, how they did their contracting for 2 years. We sat and talked to the guy for 20 minutes. I had questions about how he was thinking about his contracting and how he was playing his hand. And I thought he had really good answers, but I didn't need to hear his answers. I'd already seen him play his hand for 3 years. But if he was hit by a bus tomorrow, look, I'm buying equipment at 10 cents on the dollar. I feel like I could run the thing, and I've never even been on a drill ship. No, it's, if you put good people around you, it'll work just fine. And if the guy is 80% as good, it'll work just fine, except what it's so cheap. And that's kind of how I think about it.
Yeah, no, I think that's perfect. I've always found the same thing. Just avoid those people as much as you can because they're very good at what they do for a reason when it comes to convincing people of things. I tell a story often, but I'll tell it here because I haven't told it on the podcast yet. But I was on a team in the Air Force, and this is like an acquisition team. So we're like awarding contracts And we get a bunch of submissions for a project. And so, it's basically a pitch deck at the end of the day with a bunch of like nerdy details that I didn't understand anyways, but that was other people's problem, not mine. But like you would read through some of this stuff, and this wasn't even like an in-person pitch. Like it's slides. And I come away like, this is going to change the world. This is amazing. And then I go talk to the rocket scientist that actually understands what's going on. And he's like, yeah, no, like, let me explain to you the 10 reasons why this is the dumbest thing I've ever read. And why there was one that he was like, no, this like physics suggests what they're saying is literally impossible. So like, it made me realize like, if I'm that gullible because I don't know, the actual details the way like the rocket scientist does, like I better be real careful with all pitches of all things for the rest of time, unless I'm also an expert in it, and I'm an expert in nothing. So there you go. So something I want to go deep on real quick is KEDM. For anyone that doesn't know, KEDM is Kuppy's research service. Kuppy's an event-driven monitor, and it's awesome, and it goes deep. And I've never heard you really talk too much about how deep. So these things are 150 pages long, and it's weekly. It's grade A stuff every week. So I know this isn't all you doing this. Obviously, you have a team doing it, but I want to quickly rip through in my micro machine voice all the things you guys cover, and then we'll talk a little bit about like how you end up using it. So we have spin-offs, carve-outs, spin mergers, insider buying and selling clusters, buybacks, investors' days, short squeezes, IPOs, unlocks, price secondary, CEO changes, bankruptcy, SPACs, newsletters, 13Ds, M&A, busted M&A, stock splits, listing changes, privatization, demutualization, index additions and deletions, contingent value rights, tender offers, rights offerings, fund letters. I won't mention how many of those. I don't even know what they mean to save myself the embarrassment, but that's pretty hardcore. Like, my question is, how many of the trades in your book are downstream of this stuff? Like, how much does it impact your kind of, downstream bottom line?
I think it's pretty material. I mean, a lot of these we would have flagged in some other way, but I just got sick of missing stuff. It got to be where someone would tell me about something and I go, oh, that was last week? I totally would have slayed that, or, how did I not hear about this? And we just built this. KEDM came about because myself and our COO at the hedge fund now, we were trading our own money, and this is before the fund even. We just wanted to have like a systematic approach so that we would stop missing stuff, quite honestly. And we built this systematic approach. And then it turned out that a lot of our friends wanted it. So we started sending them the weekly Excel sheet. And then we put it into a PDF because the Excel sheet got unwieldy. And then people started reaching out to us out of the blue. They said, hey, Kuppy, I heard you have this thing. Can I be on the list? And in no time, we had 250 people on this list. And then Aaron, he and I kind of agreed that, hey, we're paying a lot for this data. And we wanted to hire some other people to help us clean up the data. There's a lot of data errors and whatnot. And if we're going to hire some people, it's going to cost some money. Let's get everyone to chip in. And we said, let's have it be $2,500 a year. Everyone could chip in. And we figured we'd get about 200 people, and it paid for us hiring a couple of analysts. And it turned out to be a much better business than we expected. But that means that there's value in the data.
No, it's definitely valuable. I remember the Cole spinoff was a fun. I don't know how you say that word. Thungella. That was one that I noticed in KEDM, and I was like, oh, I want that. And that worked out.
I mean, that really worked out. I'm just pulling it up right now because I didn't remember the numbers. But I remember, like, so it started trading at like 125, and it got all the way to 1800. So, and did it all in 2 years. And I remember buying it.
And naturally, I decided because I didn't hold it the whole way.
Oh, yeah, I sold way too soon too. But I mean, I remember buying it and saying I must have a data error somewhere in my model because it was so cheap. I mean, it was trading for little more than the net cash on the balance sheet, and it was going to earn like its whole market cap every couple of quarters. And I remember thinking that between South African rand and British pounds and US dollars, I must have had a zero missing. I went through my model like 10 times. I called a friend and sent in my model. And he goes, no, it's just that cheap. I was like, it can't be it. Just do the. I would have had a bigger position, except I didn't trust my own model.
Yeah, for listeners, like I remember this because it was at peak, like everyone hates coal and like coal's over. Like it was pretty close to like the Economist cover about like coal being dead and everything. Like it was like the perfect time to spin it off, and it made sense. Like the fact that everyone wanted to spin off their coal, like that alone kind of told you something. So that was why I was like, this seems perfect. And I'm glad I didn't make a model, because I probably would have just messed myself up and not bought it. Sometimes paying no attention to the details helps me. But speaking of, if I had a team doing that hardcore of work on all that because you didn't want to miss it, maybe I would take a vacation too.
I'll say though, on the data side, I see a finished product. They get it to me. The deadline's Friday night. It's a finished product, all 150 pages. They've already flagged the cliff notes that they think are interesting. I usually add or remove one or two. I tend to write the commentary. We just figured, you can't just send everyone a giant PDF with nothing in it. So we tossed in a commentary. But for me, how I use it, I come here on Saturday morning, I write the commentary, but I spend a couple hours usually, unless I have something else doing or some raging hangover. I'm going to go and flip through it. I mean, I built it for me, and it forces me to do it. If I didn't have a deadline to get my commentary out, I'm sure I'd be missing. It'd get to be Tuesday. I'd be like, I'll check it on Wednesday. And then, it's Wednesday. Nah, I got something else. And this forces me to stay disciplined and actually go through it so I don't miss anything. No, we still miss stuff, but we've missed a whole lot less, and we produced a ton of alpha for ourselves. And, I know we have a lot of people who keep renewing their subscriptions, so they must be getting value out of it too.
All right, a couple questions I like to ask everyone. I'll start with books. What is your favorite book that is more than 30 years old?
All right, so I'm going to cheat here a little and say it's Tomorrow's Gold in terms of a finance book. It's from 2002, so we got 22 years, but it's by Marc Faber. And
I'll allow it.
It's literally the cheat sheet on how to make money in finance. You should read that every couple of years in your life. I mean, for that, read that and read Reminiscences also, which is about 100 years old. But between the two of them, nothing is new ever in markets. They always repeat. Tomorrow's Gold is just following cycles over and over again, cycle, and the histories of cycles. And then Reminiscences is just emotions. All these things repeat the emotions of it all.
What is the biggest thing you've changed your mind about in the last year?
So I thought you were asking about markets. I had this view that we would have, like, before Project Zimbabwe started, they would have a crisis, and the crisis would force them to print obscene amounts of money, just like during COVID, and that would set it off. Now I think we're just going to sleepwalk into it, where the bond market's going to just show up one day, no bid, and they're going to do YCC, and Project Zimbabwe starts when YCC starts. And I'm very much of the view that there's a number, I don't know if it's 6% or 7% or 8% on the 10-year, and we're probably going to get there, the next couple of quarters, where they just draw a line under it and say no more. It's like Gandalf, you shall not pass. And the way you do you shall not pass is YCC. And that sets off Project Zimbabwe. You don't have to have that recession, your Grim Reaper. It could just sleepwalk into it.
Yeah, no, that makes a lot of sense. So another question I want to ask, and this is very self-serving, but I like to ask people, is about any tools you use that you think maybe other people don't use. And this could be like a little bit of anything. So for me, like using an app that like reads things out loud really fast to me, something like that adds value to me. It's like, is there anything you use that you don't think other people use? It could be really anything that you just think just makes you more productive.
I'm not a very productive person. I don't use technology very well. I literally don't know how to use my email. No, I think the thing that I do that most people don't do is I don't build big spreadsheets. I don't build fancy models. I just call up people who are, not really finance, but like not dumb either. Someone like my dad, they say, I'm thinking this, what do you think? Does this make sense in the real world? My dad was a surgeon. He, is educated, but he's not in the midst of it all like we are, where we're saying, oh, what's the Fed going to do next? And what's the next Fed meeting look like? And hey, looks what happening in this currency. Like, we're too deep in this. We're lost in the flow. We can't have a common thought. Where my dad can just be like, nah, that makes no sense. What are you talking about? Just shut up. You're wasting your time. And I don't feel like enough people do that, where it's just like, does this pass the common sense smell test of how the world actually works versus how you want it to work on an Excel spreadsheet?
Gotcha. How do you think about a trade that you get right for the wrong reasons? So let's say you've built something in your head, like for why something should go 3x, and then it does, but it had nothing to do with like kind of why you saw it getting there. Like, how do you deal with those? Obviously it's a great problem to have, but
that's happened to you before? That's never happened to me.
Well, maybe not a 3x, but yeah, I've had positions where like I'll get something right, and then I'll have clients like high fiving me. They'll be like, "That was a great call," and I'll go back and like read my own stuff, and I'm like, "Yeah, as it turns out, like that was a great trade." And then, but if you go read what I said, it was for none of the reasons I outlined, and it's so natural gas is one that comes to mind. I mean, I was right half for the reasons I thought, but then like a bunch of other stuff happened that just juiced it. But to me, the reason I asked the question is I've found it important to go back and make sure like the analytical framework, like you understand why you were right. And if you got lucky, I find it, at least for my process, to be important to kind of notate that, so that I don't like halo affect my own thinking on other stuff in the future, I guess.
Yeah, I would say I don't get lucky very much. You have better luck than me. I think let's go back to uranium. It's not so much that I got it right for the wrong reasons. It's that I got lucky and stuff. I got lucky that Kazakhstan had a coup, revolution, whatever you want to call it. And it raised the geopolitical risk level. Kazakhstan, in my mind, was a C country that was really trying their damnedest to become a B country. They were doing all the right things. They're, trying to toe the line between the U.S., Russia, and China. They were trying to do all the things that get you upgraded to a B. And then they had this revolution and they're a D. They're just stuck in a bad neighborhood between two bad people, right? And, as a result, you can't put capital in there to invest. So it made it harder to do the next cycle of development of uranium. It's just, I got lucky and it accelerated the thesis. But it's not that I got the trade right for the wrong reasons. I think I would have been right on uranium anyway. This just was an accelerant.
Yeah, that makes sense. I think maybe you having the like long time horizons helps you kind of clear those out better than it happens for me, because sometimes what I'm doing is a little more tactical. All right, that is all I have for you. But before I let you go, definitely let everyone know all the ways and places they can find you and your work.
Well, just go to praycap.com. I publish a blog, definitely not as frequently as you do, Chase. I wish I had more hours. It seems that as I run a hedge fund, everything just gets more and more complex and it takes more time away. But go to praycap.com. I publish a blog there. Go to @hkuppy on Twitter. I promise to offend you. I basically do about 5 memes a day. I just have fun with it. And then go to KEDM.com and take a free trial and see if you can get some value out of KEDM.
Yeah, I endorse and highly recommend all of those things. Although you will definitely get offended if you go to the Twitter handle. Just be ready. All right. Thanks so much, Kuppy. Greatly appreciate your time, man.
Hey, thanks so much for having me on. I really appreciate it too.
Thank you so much for listening to the show. If you like it, please tell a friend or give us a shout out. I urge you to go to pineconemacro.com and go to the podcast tab for the show notes. We do not mail those in. I think they add a lot of value, so at least check it out. You can follow the show on Twitter @TaylorMadeMacro, and you can follow me @PineConeMacro. Just to reiterate, the intro disclaimer, nothing on the podcast was investment advice or anything that resembles investment advice. You should speak to a financial professional that can give you a detailed personal plan if that's what you're looking for. This show is just information and entertainment only. We'll be back soon with a new show, so stay tuned.